An accounting method is your rulebook for when and how you report income and deductions. The IRS cares about two big buckets: your overall method, like cash versus accrual, and the treatment of a material item, meaning a recurring item that affects timing. On the EA exam, they love asking whether something is a method change or just a one-time correction. Method changes usually need Form 3115. Overall method changes are the obvious ones, switching from cash to accrual or accrual to cash. Material item changes are sneakier. You're still on the same overall method, but you change how you treat a recurring item, like when you recognize a certain fee or expense category. If it changes timing across years, think accounting method change, not math error. That's your Form 3115 trigger. Once you identify a method change, the next question is approval. Generally, you need IRS approval to change an overall method or a material item. Classic examples: changing cash to accrual, changing inventory valuation methods, and changing depreciation or amortization methods. Here's the weird one students miss. Even missed depreciation can be treated as an impermissible method, fixed through a method change process. Form 3115 is the vehicle for both automatic and non-automatic changes. Automatic means you don't need separate advance consent, but you still file the form. Non-automatic means you're asking permission. Also, watch the timing. You file Form 3115 with a return for the first affected year, the first year you're actually making the change. On the exam, that phrase, first affected year, is a giveaway. Sometimes a change is required by law. In that case, you still may file Form 3115, but you're not begging for permission. Example: a profitable C corporation grows and now exceeds the gross receipts threshold that forces accrual accounting. That's a mandated change. The exam angle is simple. Required by law changes aren't elective, and the filing is tied to the first year the law forces the switch. Now the payoff concept. The Section 481A adjustment. When you change methods, you can't double count or miss items. So Section 481A is the catch-up adjustment that bridges old method to new method. If the change creates extra deductions you should have taken earlier, you get a negative Section 481, a partner adjustment, reducing income in the year of change. Missed depreciation is the most tested example. For missed depreciation, you don't amend a bunch of old returns. Instead, you file Form 3115 and compute the depreciation you should have claimed, even for closed years. That total becomes a negative Section 481, adjustment, typically shown as a separate line with a Section 481 adjustment notation. There's also a de minimis style rule mentioned in guidance. If the entire adjustment is under $25,000, it may be taken fully in the year of change. Harborview Realty Services made a $200,000 down payment on a commercial building and assumed a $120,000 mortgage. They also paid $4,000 in attorney's fees to perfect title and spent $20,000 on permanent improvements before placing it in service. The property tax bill values the land at $70,000. What is Harborview's basis for depreciation? The options include $274,000, $250,000, $324,000, and $320,000. Think about it. The answer is $274,000. Start with total cost basis. $200,000 plus the $120,000 mortgage assumed, plus $4,000 title legal fees, plus $20,000 improvements. That's $344,000 total basis. Then allocate out the land value, because land is not depreciable. Subtract $70,000 and you get $274,000. A tempting wrong answer is $344,000 because it forgets to remove land. Cedar Valley Foods is a fiscal year C corporation using the accrual method. Which requirement must be met for the company to deduct an expense? Some choices focus on paying the bill, others focus on receiving an invoice, and one choice says the all events test plus economic performance, which is required for accrual deductions. Think about it. The correct answer is the all events test and economic performance. Accrual taxpayers generally deduct when liability is fixed and determinable and economic performance has occurred. Payment is not automatically required, and neither is receiving an invoice. The tempting wrong answer is the one about getting a bill, because it feels practical, but it's not the legal standard.